The American dream has always had a white picket fence, a manicured lawn, and a 30-year fixed-rate mortgage. For decades, we were told that buying a home was the ultimate sign of making it. It was the safest investment, the bedrock of wealth, and the final boss of adulthood. But as we sit here in 2026, the script hasn't just been edited, it has been completely rewritten. If you've been feeling an immense pressure to lock something in before you're priced out forever, I need you to take a deep breath and listen very closely to the numbers that the headlines aren't telling you. The housing market just flipped, and the obvious choice to buy has become the most dangerous financial trap of the decade. To understand why the ground is shifting beneath our feet, we have to look at the great stagnation of the last few years. We emerged from a period of historic interest rate hikes, waiting for the crash that everyone promised was coming. But the crash didn't happen in the way people expected. Instead of prices plummeting, the market simply froze. Sellers who locked in 3% rates in 2020 refused to move, and buyers were priced out by 7% or 8% rates. We entered a stalemate. But in 2026, that ice is finally cracking, and the water underneath is much colder than people realize. The math of homeownership in 2026 has crossed a terrifying threshold. For the first time in modern history, the price-to-rent ratio in major U.S. hubs has reached a point of pure insanity. In cities from Austin to Charlotte, and even in the suburbs of the Midwest, it is now statistically 40% cheaper to rent a high-end apartment than it is to own the median home next door, when you factor in taxes, insurance, and maintenance. We are living through the era of the rental arbitrage. While your parents built wealth through home equity, the 2026 path to wealth is being built by those who avoid the money pit and redirect that massive overhead into high-yield assets. Let's talk about the hidden tax of 2026: insurance and climate risk. This is the plot twist no one saw coming 5 years ago. In states like Florida, California, and Texas, home insurance premiums haven't just risen, they've exploded. We are seeing insurance deserts where private carriers are pulling out entirely. When you buy a home today, you aren't just paying the bank, you are subsidizing a failing climate infrastructure. I've seen portfolios where the cost of insurance and property tax now exceeds the principal and interest of the mortgage itself. When your asset costs you 5% of its total value every year just to keep it standing, it's no longer an investment. It's a liability disguised as a dream. But the real reason the market flipped is the inventory tsunami. For 3 years, builders were hesitant. Now, a massive wave of new construction, specifically build-to-rent communities, is hitting the market. Supply is finally catching up, but it's a different kind of supply. The starter home is dead, replaced by modular, efficient, and tech-integrated housing. If you buy an older, inefficient home now, you are buying legacy tech in a world that is moving toward AI-integrated, solar-powered living. In 2 years, that 1980s fixer-upper will be the equivalent of a flip phone in the age of the smartphone. The depreciation risk is real. I want you to imagine 2 people, Alex and Sarah. Alex follows the old script. He scrapes together every penny for a down payment on a $500,000 home at 7.5% interest. He is house poor from day one. Every leaking pipe is a crisis. Every tax hike is a threat to his grocery budget. Sarah, on the other hand, looks at the flip. She rents a modern, beautiful space for $2,500 a month, far less than Alex's $4,200 mortgage. She takes that $1,700 difference and pours it into a diversified portfolio of dividend-paying stocks and index funds. By the time we reach 2030, Sarah isn't just wealthier, she is mobile. If a better job opens up in a different state, she packs a suitcase and leaves. Alex is anchored. He is a slave to a zip code that might be declining in value. In the 2026 economy, flexibility is the ultimate currency. The golden handcuffs of a mortgage are only golden if the house appreciates faster than the stock market. Spoilers, in 2026, it isn't. There is also a psychological flip happening. We are seeing the destigmatization of renting. The younger generation has realized that owning the dirt doesn't make you a better person. It just makes you a customer of the bank. We are seeing a rise in lifestyle investors, people who live where they want by renting, but own assets that actually produce cash flow. Why would I tie up $100,000 in a down payment that produces $0 in monthly cash, when I can put that money into a dividend lab and have it pay my rent for me? The narrative that renting is throwing money away is the greatest marketing lie ever told by the banking industry. You aren't throwing money away on rent any more than you are throwing money away on groceries or Netflix. You are paying for a service, shelter. And in 2026, that service is on sale, while the product of home ownership is being sold at a massive premium with a defective warranty. Wait for the capitulation. In every market cycle, there is a moment where the holders finally give up. We are starting to see it now. Corporate landlords who over-leveraged are starting to offload portfolios. Airbnb hosts who realized that passive income is actually a full-time hospitality job are listing their properties. The for sale signs are staying up longer. The price reduced notifications are hitting our phones every morning. This is not the time to catch a falling knife. This is the time to build your war chest. So, what am I doing? I am sitting on the sidelines, but I'm not idle. I am aggressively building liquidity. I am waiting for the moment when the fear of missing out, FOMO, turns into the fear of being stuck. When the neighbor who laughed at your rental apartment starts complaining about his underwater mortgage, that's when you know the bottom is near. The 2026 housing market flipped because the math stopped making sense. And in the world of finance, math always wins in the end. The house will always be there. The land isn't going anywhere. But your opportunity cost, the money you lose by making a bad bet today, that is gone forever. If you want to be wealthy in this new era, you have to stop thinking like a consumer and start thinking like a capital allocator. A home is a place to live, but a portfolio is a place to grow. Don't let a 20th century dream ruin your 21st century reality. The market has flipped. The question is, have you flipped your mindset to match it? We are entering the great re-entry. Eventually, the numbers will balance out. Interest rates will stabilize, or prices will undergo a hard correction to meet the reality of wages. When that happens, when the cost of owning is once again comparable to the cost of renting, I will be there with a massive pile of cash ready to buy. But until then, I am perfectly happy throwing my money away on a lifestyle that gives me freedom, while the homeowners around me are trapped in a burning building of debt and maintenance. Stay patient, stay liquid, and most importantly, stay cynical of any expert who tells you that now is always the best time to buy. Because in 2026, the best time to buy is tomorrow, or the day after. But it certainly isn't today. The flip is here. Make sure you're on the right side of it.